Hello, everyone, and welcome to episode 7 of Ask Mortgage Mike, where I take topics that have been asked of me regarding the mortgage industry and the mortgage process and try to explain them to you best as I can. So today we're going to go ahead and talk about credit scores and how they impact interest rates and what you need to concern yourself with when it comes to your credit score. So obviously we all know credit scores have a direct impact on your ability to get financing for a home. Most lenders are going to put you at a cap at 620 for an interest rate. Some will go down to 580, some will even go all the way down to 500, 550. But for the most part, most financing requirements are going to require a 620 credit score. And so today I'm going to talk to you about the impact of your credit scores from a 620 and above. So for every 20 points, your credit score is increased or decreased, depending on how you want to look at it, between 620 to 639, that's one interest rate or one price. From 640 to 659, that is another price. All the way up to 850 is where the max credit score is. So let's assume that about 760 is where the pricing cutoffs end. You can get some price breaks on interest rates or on mortgage insurance above that. Really 740 is where Fannie Mae and Freddie Mac stop crediting you or giving you a reward for having higher than that credit score. That's why most investors or lenders, when they price you out, they use a 740 credit score. So for every 20 points your score drops below a 740 credit score, your rate or your price will diminish. Now, it may not affect the interest rate, but it may affect the price. So let's say that you have a 740 credit score, and in a month you go back out and you find the house, and you have to have your credit repulled, which your credit scores usually are good with a lender for 90 days. Some will go up to 120 days. But let's assume that you're outside of that threshold, you have to repull, and that credit score drops to a 735 now. Well, you're going to have to pay in price probably a quarter of a point or 0.25% of your loan amount in fees that you would not have had to have paid on the 740 or above. And that happens all the way down to a 620, and some of the loan level price adjusters, meaning the credit scores hits, can be as high as 100 basis points or 1 percentage point of the loan amount. So as you can see that a 740 credit score might give you a 3.75% rate. In a 620 credit score, you may have to get a 4% or 4 1/8, 4 1/4, whatever the market dictates at the time. But the interest rate would be higher based on the credit score if it was lower than the 740. The other thing to make sure that you're looking out for when you're getting into the interest rates and the price adjusters are you need to make sure that you find a lender that's able to work on your credit score. So if you have a price or a credit score of 640 or 639, and you know that if you can get it to 640, you're going to save 100 basis points or 1% of the loan amount, you need to make sure that you have a mortgage company that's willing to work with you to get the scores up above. Usually takes anywhere from 3 to 5 days, depending on how easy. Some can take a little bit longer, but most good mortgage companies have the capacity to do a rapid rescore where they would be able to take and get your credit scores increased for you rather than waiting the 30 to 60 days. So again, I hope that answers some questions regarding how the industry looks at credit scores and how credit scores directly impact you. So again, thank you for watching episode 7 of Ask Mortgage Mike. I hope everyone has a great week.